Welcome back to this business planning series. So far in this series, I have taught you what a business plan is and why a business plan is needed. I have also gone through creating an expenses forecast and a sales forecast using Microsoft Excel. We're now going to move on to the cash flow forecast. So there's a few things to mention about a cash flow forecast before we get started. Number one, what is the cash flow forecast? Well, as the name suggests, a cash flow forecast forecasts or projects cash, the cash in and out of the business. In the world of business, cash is king. Even if you have a very profitable business, if there isn't sufficient cash, then the business will go under. And most businesses fail due to a lack of profitability or a lack of cash. They're two separate things. So having a cash flow forecast and ensuring that there's always going to be sufficient cash in the business is really essential. Now, a cash flow forecast is not a profit and loss statement. So a profit and loss statement shows the profitability of a business or entity. It's simply the sales minus the expenses gives a profit figure. The cash flow forecast doesn't do that. It does not project profits or state profits. The cash flow forecast simply is all money into the business, so money flowing into the business, and all money flowing out of the business. All money in and all money out. Now, obviously, some money in is going to be sales and some money out is going to be expenses. And perhaps most money in is going to be sales and most money out is going to be expenses. But once again, this is not a profit and loss statement. It is a cash flow forecast. So money out of the business can be things like drawings, owners taking their share of profits. That's not an expense, but it's going to be money out of the business and could be a significant amount of money out of the business. It could be asset purchases, it could be tax payments, it could be paying off debts. All these things are money out of the business but are not expenses. These things do not show on a profit and loss statement. And then money into the business, obviously a lot of it hopefully is going to be sales, but there can be other money into the business such as capital or investments. If the owners are putting money into the business, that's not a sale, but it is money into the business bank accounts. It's cash in, flowing in to the business. Other things could be loans, bank loans, other loans come in to the business, which are not sales. So that's a few things to mention about cash flow forecasts. Let's move over to Excel and get started. So here we go. We are back on Excel. This is the sales forecast that we created in the previous video, and we also have the expenses forecast here. Now on sheet 5, we are going to name this cash flow. So that's going to be our cash flow forecast. Now the reason why I have put this on sheet 5 rather than sheet 3 is we need sheet 3 and sheet 4 for assets and liabilities. So sheet 3 I'm going to rename as assets, sheet 4 liabilities. So as mentioned, with the cash flow forecast, we can include, or we should include, the expenses and the sales, but that's not going to be enough. We also need to include assets and liabilities. Once we have all 4 of these tabs, we should have the needed information in order to create a accurate and complete cash flow forecast. So before we really move on to the cash flow forecast and start creating that template, we need to create templates for assets and liabilities. Now it's going to be quite straightforward because all we're going to do is go to the sales forecast. We're going to click at the top left and copy this, and then we're going to bring it across and paste it to our asset sheet. The company name is still the same, the Bookkeeping Master Limited. Obviously, you could just put company name up there or whatever your business is called. And in here, we're going to do 3-year asset forecast. So now we have a 3-year expenses forecast, a 3-year sales forecast, and a 3-year asset forecast. Now the great thing about copying this thing and pasting it on the sheet is all the formulas are done and all the tables are done. So just like the sales forecast, it was really easy. It was pretty much a copy and paste job. The asset forecast is going to be very similar to that. So in these rows we can put names of assets. So we could perhaps have property. If the business was going to buy property, that could be the first one. We could have computer, equipment, there could be machinery, and there could be a number of other assets. So you would list all the assets in these rows. As mentioned in the sales forecast, if you don't need all these rows, and you probably won't when it comes to assets, because there's not that many categories of assets that you can purchase. So when it comes to assets, you can delete these rows. So let's go ahead and do that in this video. I'm going to highlight from 10 to 19, then right click on the rows and click delete. And then what we can do is, if I delete the information in year 2 and year 3, and then copy this, paste it to year 2 and paste to year 3. That way everything is uniform and tallies up. And once again we can delete these rows that we don't need. So 18 to 27, I'll delete them. And also 28 to 37, I'll delete them. Now at this point it's worth checking that all the formulas are still working. So let's put some numbers in here. The months are still working, which is great. And the years are still working. So we have 1,000 for year 1 and 500 for year 2. So that looks really good. Now the next thing we need to do is just make sure this is still printer friendly. So let's go over to print. Let's change the layout first of all. So page layout orientation needs to be landscape. It looks like it is still printer friendly, which is great. So print, so lovely, it all fits on one page there. So this is our 3-year asset forecast. So everything's working. Now, not quite done yet with this asset forecast, because there's something we need to include on this asset forecast, and that is depreciation. So depreciation is an expense that we haven't included on the expense forecast, but it's to do with assets. So what we can do with these totals down here is we can add another column which we can call depreciation, or some sort of abbreviation for depreciation. I'm going to center that, make it bold, underline it, and then I'm going to put a pound sign. So depreciation, and what we're going to do is do a formula here. We're going to do equals the figure in year 1 times, which is the star sign, 0.25. So depreciation usually is around 25%. If you know what your depreciation is going to be, then you can obviously put 0.18. If it's 18% or 30%, you can put 0.30. Now just to demonstrate this, we bought some computer equipment for £1,000. Then we have an asset total of 1,000 at year 1, and we have depreciation of 250, which is 25% of the 1,000. So let's just get rid of that and come back down, and we need to do depreciation for these other 2 years. Now before we do that, we need to add a third column, which is going to be closing. This is the closing value of assets at the end of each year. And once again, this is going to be in pounds, but you can do it in dollars, euros, yen, it doesn't really matter. Now the closing is going to be the asset purchases minus the depreciation. So C36 minus D36 on my spreadsheet. We'll click enter. And then let's just demonstrate this. So let's do our £1,000 asset again. We have £1,000 asset purchase, 250 depreciation, the closing balance of 750. Now the reason why we need to do a closing balance is we will need that for the balance sheet, the projected balance sheets, when we do them later on in this series. But we also need to know the closing balance in order to work out the depreciation for the next year. So for year 2, the depreciation is going to be equals, open a bracket, it's going to be asset purchases plus the amount brought forward from the previous year. So asset purchases plus the closing balance from the previous year, close bracket, times by 0.25 or whatever the depreciation rate is. So let's click enter. So now let's just demonstrate that. So in year 2, if we buy something for 500, the depreciation is 125, which is 25% of this. But if we have a balance from the previous year, such as 1,000, then the depreciation actually goes up to 31250. The reason being we're depreciating the assets purchased in the year, but also the assets still in the business from the previous year. Now the closing balance for year 2 is going to be equals the closing balance from the previous year plus, open bracket, new assets purchased minus depreciation. So on my spreadsheet we have equals E36 plus, open bracket, C37 minus D37, close the bracket, gives us our depreciation for the next year. So we're going to go equals, open bracket, assets purchased in the year plus closing balance from the previous year, close bracket, times by 25%. And then the closing balance will be the same as year 2, which is equals closing balance from previous year plus, open bracket, assets purchased minus depreciation for the year, close bracket. So that's it for our asset totals. Apart from the projected balance sheets, this is as difficult as it gets. So if you do feel a bit overwhelmed in this video, please just rewatch it, take it slow. You can pause the video. If you have questions, then leave something in the comment section below. Obviously, I do provide business planning services if you'd rather just outsource this stuff to me. But do your best, see what you can do. The video is for free and there is a pause button. So just take your time and rewatch as many times as you need to. So let's clear this off. So that's the asset forecast done. Let's now do the liability forecast. Now, thankfully, the liability forecast is pretty straightforward. So all we're going to do is copy our asset forecast, bring it over to our liability forecast and paste that. We can then change the title to 3-year liability forecast. Everything is printer friendly and all the formulas are ready to go because we've copied from the previous spreadsheet. And we can change these titles to match the liability. So we could have a bank loan. We could have a second bank loan. And perhaps some sort of investment. Obviously, if you need more rows or less rows, you can change accordingly as shown in previous videos. So I've just copied that and brought that down so each year matches. Going down to our totals here, we do not need the depreciation or the closing balance, so I can delete them. I've just highlighted and pressed delete. The only thing we need to add is a column for interest. So if there's any interest on these bank loans and other loans and liabilities that the company has, we can enter that here. Now, I don't have any formula for interest because interest rates are always different and it's calculated differently and there might not be any interest at all. So what you'll need to do is calculate the interest per year and then just enter that manually in these boxes. So the full interest for year 1, full interest for year 2 and full interest for year 3. That will be entered here because we'll need these figures later on when it comes to the projected profit and loss statements, because interest is an expense. And that's the liability forecast done. So we're now in a really good position to create the cash flow forecast template, and we will do that in the next video. Once again, thank you so much for watching. Feel free to watch more videos. There will be a link in the description below for the next video in this series if YouTube is not recommending it automatically. All videos are listed in order on my website, freebookkeepingaccounting.com.